Welcome back to Yahoo Finance Live. We are continuing to watch some of those streaming names in this session one day after that big merger announcement between WarnerMedia and Discovery. Netflix, Amazon, Disney, all trading higher. Comcast lower, though. That's one of those names that's been speculated about whether, in fact, this new deal is likely to force their hand into being a bit more aggressive on the content side as well. Amazon, of course, we got that announcement, or at least those reports this morning that suggest they may be looking to acquire MGM. Let's bring in Michael Hodel. He's analyst for Morningstar. Michael, it's been a busy few days for you, I imagine. But, you know, as we look to the headline today, at least, in terms of Amazon potentially being interested in MGM, is this the kind of move that you think is likely to be accelerated as a result of AT&T's moves as well as Discovery?
Yeah, I think so. I think that the firms that own content, that produce content, are realizing that they need to have a solidified position for reaching consumers directly. And so if you have maybe a hole in your content lineup, you're going to be looking for ways to fill that. I think that's a big piece behind the WarnerMedia and Discovery deal that we saw yesterday, is the two firms complement each other reasonably well on the scripted and non-scripted side of the business. And you mentioned earlier that Comcast might be interested in coming into the marketplace as well and participating in some of this M&A activity. We've long thought that Comcast and WarnerMedia would actually, or NBC Universal within Comcast, would fit together really nicely, with a few pieces that would have to be spun off to meet regulatory approval, but that the two companies would complement each other really well. So, you know, we don't think it's highly likely that Comcast would get into a bidding war here for WarnerMedia, but it's a possibility that I don't think you can rule out, that as these players look to move pieces around to ensure that they have the reach that they need to build a platform for the long term, that these firms might start to look in more places.
And Michael, I mean, we're also seeing AT&T shares down today under pressure here as we kind of dig into maybe the impact of them cutting their dividend down. I mean, what do you make of that and the way that was kind of, you know, it took a while for, I guess, the market to focus in on it. But what do you make of the reaction here as we're seeing it in day two of digesting the news?
Yeah, I think the reaction is understandable. There's a large percentage of AT&T shareholders who are in the stock for the dividend, and AT&T has defended that dividend until yesterday, essentially, as recently as their analyst day in March, saying that they were committed to a stable dividend. So I can understand that a large percentage of investors would be disappointed and want to exit the stock at this point. But from our perspective, the dividend cut's actually the right move for the company. I think when you look back over the last 5 or 6 years, one of the real disappointments for AT&T is that they haven't been able to defend the stock. They issued a lot of shares to buy DirecTV and then Time Warner, which increased their dividend commitment. And in the process, they also added a lot of debt to the balance sheet that made the debt holders and even shareholders uncomfortable with the level of leverage on the company. And so the firm's ability to come in and defend the stock when the yield on its shares pushed up into the 6 or 7% range was very limited. They did do a buyback at the start of 2020, but had to shut that down when the pandemic set in. So I think that by pulling back on the dividend, prioritizing the balance sheet a little bit more even than they have over the last couple of years, and giving the firm some financial flexibility, they'll have the ability to have a much more solid foundation for the next decade or 2 decades to invest in the business where they see opportunities, and also to defend the stock if it sells off and the yield on the share starts to push back up into the 5, 6, 7% range, and it becomes very clear that they can improve their cost of capital by borrowing rather than issuing shares.
Michael, it's been a span of a few weeks. We have seen Verizon, our parent company, unwind their content business, and now you've got AT&T doing the same. I mean, it felt like for a while there was this betting on essentially, being able to increase their reach for digital ads by building out the content. I mean, is that, maybe not fair to call it an experiment, but do you think that the verdict is already out that partnership simply doesn't work because of the expensive proposition on both sides, the telco side as well as the content side?
Yeah, I think there's a lot of reasons why, why content and distribution don't marry up all that well. A big part of it is on the regulatory side. I think your ability to draw information from the telecom side or if you're a cable network side and use that information to better target ads is very limited. If a Verizon or an AT&T tried to do that to improve their ad targeting by pulling information from their wireless business or their broadband business, I think you'd quickly have public outcry. You'd have regulators stepping in and really questioning that move. And so I think it's really difficult to find an informational advantage for putting the content side and the distribution side together. But even strategically, you look at what AT&T is doing with WarnerMedia, I think it makes a lot of sense to spin WarnerMedia out, because over the last couple of years, as AT&T's tried to build up HBO Max, they've really focused on the AT&T wireless customer base. By separating out HBO from AT&T, now HBO is free to go seek partnerships as widely as possible, so they can build as wide of a platform and as wide of an audience for HBO Max as they possibly can, which then has the impact of bringing in the best content creators. If you don't have the ability to reach a wide audience, you're not going to attract the best content creators. So I just think strategically it makes a lot of sense to spin the media business out of the core distribution business, separating WarnerMedia from AT&T.
Yeah, and Michael, I mean, I guess yesterday we were having this conversation about people out there topping out at maybe 4 streaming services that they would want to pay for. If you kind of believe that, I imagine if you look at the competitive landscape right now, who's on the outside looking in here? If things are getting scooped up as rapidly as this, 2 back-to-back deals here, potentially in the space, I would assume that puts pressure on Apple here to get their act together, maybe on scaling things up. Who has the most pressure facing them now?
Yeah, I don't know necessarily that I would agree with the contention that there's only going to be 4 streaming services long term. I think there's still a lot of consumer preference that's yet to be established. You bring up Apple. I think Apple's in an interesting position. They've dabbled in content creation, but they also have a great media aggregation device with Apple TV. So maybe you could see Apple trying to create a wrapper type service and becoming more content agnostic and bringing a wide variety of streaming services together under, almost like reaggregating the bundle. That's a possible way that Apple could approach the market that would then help the more fringe content creators find an audience. But I do think that your premise that there's going to be a handful of dominant platforms is right. And you look at, obviously, Netflix has the runaway lead right now, and Disney Plus, disappointing numbers recently, but still doing very well in terms of building out their base. And HBO Max, we think, has done a great job too of capitalizing where they can on the pandemic and bringing movies onto that platform to really broaden the appeal of it and bring people in, is doing a great job too. So then outside of those 3 platforms, I don't think there's really any consensus or a clear-cut number 4 player. Maybe Amazon, but they're such a behemoth, they can do whatever they want. And if they choose to push even deeper into content, they could do that. I view them more as a wild card in the platform war.
And Michael, finally, where does this leave somebody like a Facebook or Google? I mean, you talk about why these telcos got into the content business in the first place. The reality is Google and Facebook dominate the digital ad space. Do you see them looking to seek out in many ways to beef up content more aggressively?
I don't know if they necessarily need to beef up their content. I think if you look at what Google is doing with YouTube TV and the YouTube platform, really trying to find ways of bringing tools for advertisers to reach audiences wherever those audiences happen to be. I think that's the best strategy for Google going forward, more so than trying to push into content. Google did start to push a little bit into content and they've pulled back on that. So I think that's the right approach, where you're just trying to build the advertising tools to help people that are trying to get a message out, reach audiences wherever they can find them. I think that makes the most sense when you have already dominant positions in digital advertising like they do.
Michael Hodel, Morningstar Analyst. Good to talk to you today. Thanks so much for your time.